Joining us now to discuss is Zack Voell, Director of Content and Research at Compass Mining and former CoinDesker. Welcome to the show. Zack, you've just published the North American Bitcoin Mining Index report, so congratulations on that. And one of your findings is that greater Coinbase rewards have generated greater profits for existing miners, which means more investment in hardware, infrastructure, and competition. So how is that dynamic playing out in the Bitcoin mining world right now?
Yeah, hey Christine, it's great to be back. I'm excited to talk about there's so much going on in mining right now. Up to until, I guess, about a month and a half ago, it's been one of the most lucrative times to be in mining, just given the price appreciation of Bitcoin since March 2020. And now, curiously, even though the price is significantly off its highs from mid-April, Bitcoin miners are still about to see a significant boost in their bottom lines from that is, miners with machines still online, from the massive difficulty downward adjustment we're about to see in early July. Basically, the way that happens is it's easier to mine Bitcoin now than it was at similar price levels earlier in the year. But the same time, the price at which Bitcoin's difficulty was last at the level it's about to fall to, Bitcoin was trading around $9,000. Now it's almost at $35,000 or $36,000. So for a much more expensive Bitcoin, the amount of energy required to mine a Bitcoin is the same level as it was. I think this was late 2019 or early 2020. But across the board, we've seen massive revenue inflows for miners. The more money that flows into mining, the more they can invest in better hosting facilities, buying new hardware, and general improvements in market structure. So there's really never been a better time to mine Bitcoin.
Right. I'm seeing one miner, Argo Blockchain, just announcing that they secured a 20 million Bitcoin-backed loan agreement to expand its operations in Texas. So we do see some investment in the space. But from your report, what are some of the key findings that you found?
Yeah, for sure. I wish we had an hour to talk about it or more. It's over almost 50 pages of research compiled over about a 6-month period, with input from dozens of miners, manufacturers, and other industry leaders. I think the high-level takeaway is that there's just massive growth potential for mining in North America. And we see a lot of people talk about this, a lot of headlines, a lot of social media chatter. But the purpose of this report is to really offer a solid source sort of to clarify the growth potential, the limitations, and just the landscape of what mining looks like in the US and Canada now. The growth potential for North America basically comes from its advantages with clear regulatory regimes, much stronger capital markets, and those both feeding into this region's opportunity to supplant China's hash rate and hardware market dominance. We already saw this opportunity blossoming over the past 1.5 to 2 years. And it's sort of serendipitous that this crackdown in China, although it's a major headache for a bunch of miners, is just making the opportunity for North American miners to grow that much larger. So
will that
really
crackdown in China hasten the North American growth in Bitcoin mining?
Absolutely, yes, but there is one major impediment to it, which is also discussed in the report. So miners are leaving China right now and sort of going, a lot of them to North America, but many of them also to wherever they can find available rack space. The industry is grappling with a severe shortage of hosting facility space right now. North America, Kazakhstan, parts of Africa, Latin America, all over. So basically all miners want now is a facility that can power their machines. A lot of them are coming to North America. But one thing that's important to keep in mind is while we and many others are very bullish on North American mining over the next decade or more, we're not bullish on sort of a re-centralization of hash rate as we've seen historically in China. And I don't think that will ever happen, but it's important to keep in mind that while we want a significant amount of hash rate to come back to the network, a lot of it to come to North America, we don't really want a China 2.0 where North America sort of dominates 65, 70% of the network.
And Zack, you mentioned some of the limitations of North American mining. What might some of those limitations be?
Yeah, absolutely. So the primary limitation right now is facility hosting space, or rack space, as it's more commonly called. Basically, shelves that can power these ASICs. There just isn't enough of it to go around right now. There was already a shortage of rack space before the China crackdown. And what China did basically is flood the market with ASICs that are now searching for homes that don't have them anymore. So people were already looking for rack space, and now there's two, three, four, 5x the number of people looking for more rack space. And that takes time to build, like at least 1 to 2, sometimes 3 year lead time before these new facilities can be built. Like you mentioned, Argo and Riot and many other companies are building these facilities, but it'll take time for the machines leaving China to come and find space to be hosted. But a lot of that space is in North America. It's very bullish for North American miners on all sides: hosting, pools, manufacturers, all sorts of mining companies.
There's also some big regional differences in North America: Canada versus the United States, Texas versus New York. Maybe you can go to some of those.
Yeah, absolutely. Those differences are very interesting, in my opinion, because, I mean, in the comparisons you just mentioned, the US versus Canada, and then within the US, places like Texas versus New York, the trade-off generally comes down to regulatory regimes versus energy prices. I mean, just comparing the US to Canada, for example, miners in Canada, in certain parts of Canada, to put it mildly, regulation can be a major headache for them. In the US, not so much at all. And there's different types of energy sources and pricing for those energy sources across the different countries and within regions of both countries as well. So when miners within the region already or migrating to the region from other places, for example, China, are evaluating North American availability, generally they're considering the trade-off between energy prices and regulatory regimes.